Well, plenty happening in the infra space, and on this edition of All About Your Company, we're going to be talking to Interarch Building Products. We've already called them once on the show around 6 to 7 months back, but it was a different environment back then. Now you've got structurally different commodity prices which are playing out, what the impact of that is on Interarch, and what we've seen on the stock prices last 11 months, the stock is actually down 12%. So you're starting to see that pressure on the stock price as well. We'll try and understand what this does. The second piece is that cash flow hasn't come through for them in FY26. We'll wait and watch as to that happening in FY27. The other reason why this is interesting is FY27 will mark an interesting inflection point from a volume growth story perspective as well. You're expected to see large amounts of Capex start to bear fruit in FY27. We'll get a sense of how it's playing out in terms of the Capex timelines and what it means from a top-line perspective as well. So more forward-looking than anything else, we'll try and get a sense of what's playing out. Quick summary of what we've already possibly covered a few months ago. But this was incorporated in 1983, market cap currently at around 3,200 crore. Turnkey pre-engineered building solutions is what this one focuses on. And it's one of the largest, in fact, the second largest in the PEB segment in terms of market share in India, has 5 manufacturing facilities pan-India. In terms of products, there's PEB steel structures which we do, which is framing systems. There is roofing and cladding as well, which is metal roofing systems, which they have. Ceilings, which is track ceilings, which is their brand, but it's basically suspended metal ceilings. There's LGFS, which is light gauge framing systems. And last off is non-industrial buildings as well is what this covers. But a large part, which is 85% plus of the top line, comes from the industrial segment. So really, that's where it has the largest presence. Operations, well, they have 5 design centers. Manufacturing facilities, they have 5. 2 still are under construction. 10 marketing and sales offices across India. The current capacity is 2 lakh metric tons. And the capacity utilization was approximately 90-odd%. When you're looking at sectors that they cover, it's a very wide range of sectors, and that gives it the diversification. You can see all of them on your screen pretty much. Food processing is the last one, if at all that's not visible. Food processing, packaging. You've also got electronics, you've also got paints, paper, plastic, pharma, power, renewables. They're into all of those spaces. Data center as well could be one of those levers for growth. And there's FMCG, heavy engineering, lifestyle, manufacturing, as well as multi-story construction sites. All of that is what this caters to. Business model is simple. They win orders and thereafter they execute. There is some bit of lumpiness whenever there are large orders, which requires larger working capital requirements, which stretches the cash flow. That is one of the problems that we are seeing at this point of time. But obviously, we'll get visibility on how FY27 shapes up for them. Right? Let me quickly look at the financials as well. The growth has been very decent, 19% growth last 3 years in terms of the CAGR. You've seen decent growth on that clip. And now you're closing in on 2,000 crore of top line for FY27, plus 2,000 crore plus of top line. You're looking at EBITDA growth of 17%. Margins have hit ceiling in terms of the 10% margin number. We'll come to margins and we'll see it. And profit has grown at 19% as well. So it's a decent kind of a growth clip that this one clocks. Clear thumbs up here. Margins and order book, that is relevant from a perspective that it gives you visibility going forward as well. Margins, the aspiration is to go beyond 10%. For the moment, we are sub 10%. That's where we are at where margins are concerned. When you're looking at the order book, currently, or rather FY26 year end, it was sub 1 time book to bill. Obviously, those orders keep coming through, and as a result of that, currently the order book is more than 1 time book to bill. Of the bill obviously being around 1,900 odd crore, but currently you're sitting at above 1 time book to bill, just above 1 time book to bill. But that's broadly the structure. 0.9 to 1.1 is broadly where it sits at. Also, the execution needs to happen fairly quickly. So once the order is won, the requirement for this to get executed is fairly quick. The other piece that's weighed down on Q4 numbers is also the fact that you've had some labor shortages which has come through. And we'll try and get a sense as to how that is playing out as well in the larger scheme of things. But let's look at the balance sheet now. And 880 crore odd in terms of the book value. So this trades at around 4 times or maybe 3.5 times book is what this one trades at. You're seeing a borrowing which is minuscule, frankly, and cash and bank balance which is fairly decent. No problem at all from balance sheet perspective. Receivables, though, may be a bit of a problem from a balance sheet perspective, but we look at that when we look at cash flow, and that's what we'll come straight to. The cash conversion is becoming the problem. Scale, of course, is really good. The growth has been extremely strong, 31% last year, but you're not seeing that conversion happening from EBITDA to cash flow, and that could well weigh on the sentiment of the stock as well. One of the reasons why. When you're looking at the return ratios are extremely good. You've seen 10% FY22, but thereafter you've seen very decent scale pickup. It's been between 31 to 25%. So from a return ratio standpoint, there's comfort there. Shareholding pattern also, you've got a strong promoter ownership backing there. We have Manish Garg, who's CEO, who will join us. But you have Mr. Nanda as well as part of the promoter group, and therefore you've got a decent holding. You've got FIDI interest, mild ones, of course, for a 3,000 crore company, but public holding, the balance 30%. When you're looking at valuations, this one trades at 18.5 times 1 year forward, 22 times current. 22 is the 1 year average, the last 1 year average, and the last 1 year range is between 16 and 29. So it's largely in line with the kind of range that we sit on and 1 year average valuations as well. But if we could start to see upside growth and very strong growth going forward, then this could well correct and correct very sharply. So we'll try and contextualize that basis the conversation we have with Manish. Last off is with regard to analyst recommendations. 4 analysts cover this one. No holds, no sells, all buys, and a 31% upside is what they're seeing on an Interarch. Now, mind you, negative 11% last 1 year. Already there's been negative sentiment on the stock. The next 12 months, at least the analysts seem to suggest that there is bullishness to be expected. So we'll get a sense of that. But let me bring on board Manish Garg, CEO at Interarch Building Solutions, joining us this afternoon. Manish, great having you. Let me start off, Manish, by understanding how things are shaping up for you. Give us a sense how Q1 is chugging along. Steel prices are obviously elevated. The pass-through, how easy has that been? And the margin impact, if at all any of that. My understanding is there's very low to no margin impact, but please give us the perspective.
Yeah, good afternoon, and thank you for having me on the show.
Very good afternoon.
Q1 is going along very well. We still have another 48 hours to go, so hopefully we should be on our target. So that's what the intent has been. In terms of the steel prices, they did bottom out, I should say, in the month of December, and they started going up slightly month by month, January onwards. So January till about April, they did go up every month, but not all at once, maybe gradually from January till April. And then May onwards, they have started to sort of stabilize or come down a little bit, or I should say now that the monsoon also is setting up. So how we operate, I think we did explain earlier that we have a mix of orders. There are some orders, of course, which are fixed price contracts, wherein we cannot go back to the customer asking for a price increase. But a lot of our orders are also on a variable price contract, wherein they are linked to the base price. So in terms of the fixed price contracts, wherein when the prices go down, there can be a windfall, and when they go up, there can be a little bit of a stress. We manage it through inventorizing part of our backlog orders, or book to bill kind of residual. That's what we do. So we always carry about 2 months of physical inventory in the factories, always, and we have about 2.5 months in the pipeline because the steel delivery takes about 8 weeks. So overall, we have seen that in the long run, it evens out. The effect evens out. Maybe for a month, it could be a little up and down, but overall, it does ease out. Uh, the benefit of the higher steel prices is that even if your volumes are growing at a certain percentage, the turnover can grow a little bit better based on the increased steel prices. So I think that's in perspective, and our order book continue to be very strong. We can of course talk about it as you bring it on. So I don't see too much of margin pressure, particularly on the steel prices part of it.
Got it. So steel prices, maybe a quarter here or there could be choppy, but outside of that, when you look at it from an annual perspective, you'll likely see very low impact on margins of that. That's the way probably to kind of sum it up. Manish, so I'm trying to get a sense. You've guided 15% growth FY27, right? You've got fresh capacity coming in, which pushes your capacity up by, I believe, 50%, if I'm not wrong. 25, 24, and 40. That's the increases in each of the facilities. Q2 and Q4, right? FY27. Talk to us about why guide for 15% when there is such a robust pipeline in terms of Capex, which is coming on stream.
Okay. So fair point, but I would like to factually correct the numbers before we go ahead. So we had a capacity of 200,000 tons that's coming on the screen. So yes, that's absolutely right. And we would have two capacities coming in this financial year, but only in the later part of the financial year. So let's say early July, we would be going in for Gujarat, as you know, the phase 1. And somewhere in October, November, it will be phase 2. So phase 1 and phase 2 is 20 plus 20. So the total is about 40,000 tons from Gujarat. But as you understand that it takes time to ramp up, so only part of that total 40,000 tons will actually flow into FY27. Similarly, our AP multi-story heavy structures also will kick in by, let's say, end of August or somewhere in the middle of August or end of August. And again, the full ramped up capacity of about 20,000 tons will only come up a bit later, 5,000 tons, sorry. So I should say that total capacity addition this year is going to be 65,000 tons. So that's only about 30% of our existing capacity at the beginning of the year. From 200, it will go gradually up to 265, but then it will be in tranches of 20,000 and then another 20,000 and then another 25,000. So total 65. So I should say that not all 65 will be utilized this year, only a part of it. I should say that even if I was to take half year, which is Q3 onwards, I think out of 65, only a 30-35 kind of should flow into this year. And that is why the guidance of 15%, as I said, today we are only limited by the manufacturing capacity for our guidance, whatever we have given, and not really by our capability to book order. And that reflects in our order book. But as we are ramping up capacity for next year, all of it will be in play and even more. So that is why the 15% justified. So I would not want to, go beyond that. And that is our rationale for keeping it at 15%. Because don't forget, last year we grew at 30%. So the base is larger, and the capacity utilization for our existing plants after modernization has gone up to 85 to 87% already. So that's our rationale. We are not going up by 50% capacity. We are going up by about 30%, and that too by end of the year.
Got it. So point completely taken. And you answered my other question as well, which is to say that, it's not a demand side problem. It's a supply side where supply is going to take time to ramp up. Also, my understanding is Q4, you're having one more facility which comes on stream, right? Is that going to be at the end of Q4? And is that why you're not factoring it in? Is there a 25,000 empty capacity as well, which is coming? Or have I read that incorrectly?
No, so you have read that correctly. What we are trying to do is that the phase 2 of our heavy structure unit, we are trying to bring in Q4 of the financial year, but the capacity ramp up will only happen in the Q1 of the next year. So we are only planning that the trial productions will start somewhere in the month of January, February. So while technically the capacity could come in, but its utilization can only happen next year. So you heard it right, that another 25,000 tons of heavy structures is going to come in. That's somewhere in the Q1, and that is why, Q1 of the calendar year, but then the capacity utilization will only happen in the FY28, to be precise.
Yeah, that's where I was getting to the 50%. 45% is what I was thinking of. That's
Yes,
a
you
large
can
increase.
say 90,
But that's
yeah,
FY28.
Yeah,
But,
correct.
but that's FY28, right, Manish? That's the right
That
way
is
to think of it.
Yeah, absolutely.
And FY28, there won't be a volume issue. You'll probably do the entire 45%, right? Is that the right way to think of it?
So I
Versus
think that way
FY26.
you can, at least the capacity will increase from 200K, as you showed, to about 290K with that 25,000 heavy structure coming on stream.
Correct. So and that should reflect in the top line as well, right? So versus maybe
Yeah, so
FY26 top line.
we will have FY28 definitely will have a capacity of 290 to start the year. I think that's how we should look at it.
Correct, absolutely. And therefore, if I were to use FY28 as the year versus FY26 the base, you've done 900 crore of top line in FY26. You'll do probably 45% more of that in FY28, assuming steel prices remain flat. If steel prices go up, then obviously your top line goes higher, right? Is that fair to kind of extrapolate in terms of numbers?
Mathematically, you are absolutely right. And I think that's what our guidance also has been, that if you take 15% for FY27, then we can pretty much calculate the FY28 upside from there. And it will be very near to what you just sort of were mathematically calculating.
Perfect. Now, Manish, let's talk margins, because you've spoken about double-digit margins. You've aimed for it, right? When do you get there? Is it FY27? Is it FY28?
See, there is definitely a room for margins to increase. Let me be very frank. The kind of service our industry and our company offers to the customer, the value proposition is irresistible. And I think our industry itself deserves a much higher margin than what we currently make. However, there are two aspects to it. One is external, one is internal. External is, of course, guided by whatever competitive forces are there and the other factors. But internally, we are working on a lot of methodologies in terms of increasing our throughput, increasing our capacity utilization, putting the technology to use in our engineering, in our project systems, and also in our plants. We are modernizing, we are looking at robotics to increase throughput. So we believe that we will keep working on the internal efficiencies. External, yes, we can. We are a premium priced, proposition as far as our company products are concerned. But yes, we look at, yes, there is definitely a window for at least about 100, bips or even 150 bips to go up. Right now, I can only say that we keep trying very hard to take it up. But as I said, only the time will tell as to how the margin profile, will gradually go up. But yes, if it goes up, it will be because we are working very hard on the internal efficiencies to take our margins up.
Manish, interesting you say that. So you spoke about all the internals. I want to try and focus on the more interesting part of it, the externals. You said that there is a need for better recognition or better pricing power on your side from the customer end. Do you believe that that is doable as well? And is it competition which is hampering you from increasing prices and creating better value? Is that the right way to kind of assess it? Is it only competition? Is it only penetration? Is it awareness? What is it that you're working on the pricing side of things?
So what we are working on the external side, because I'll address that, is better our offerings day by day in terms of increase more value that we provide to the customer, and thereby they recognize and we can command a bit better price and take the mind share, top of the line market share of the mind share of our customer rather. So what we're trying to do is try and improve on our entire delivery mechanism. And many of the large orders are pretty much, decided basis the capacity and history of the company having delivered it. And Interarch is right, up there. We have delivered very large and very complex projects. So I should say that externally, what we are trying to do is be a little more aggressive on the large and complex projects. That is where, our expertise in last 4 to 5 years have increased dramatically, and customers have believed in us. And there, the customers also don't mind paying you a little bit extra for getting, their projects completed without any hassles. So that's something that we are working externally on. That can we work a little more harder on that part, because that's an easier part, because we already have a history now of having delivered mega projects. Means one of the largest projects in India in our history of our industry has been delivered by us last year. I should say this financial year. To that matter, we are doing very large jobs. So I should say large complex jobs should give us a better pricing and therefore margins, because in large projects, the cost of engineering to execution is a bit lower when compared to the percentage. Means a 200 crore project is not 10 times more engineering intensive than 10 crore projects. So I believe that the more and more large projects, and you must have seen in June we declared 2 very large projects that we booked. Larger projects should increase our margin profile. That's what I think I would
Point
like
taken,
to
but
state.
Manish, it occupies more of your cash flow as well, right? And that has been one of the concerns that the street has based on the con calls that you've had with investors as well. How are you repairing that? Large project, better margin, plus cash flow.
Yeah, so I should say if you look at absolute numbers, yes, you can say that. But if you look at the number of days, we are not too bad, in terms of that. And there are 2 aspects that went into that. That when you do smaller projects, your project size is, let us say, average project size is X, then the turnaround is a bit faster. But since we are doing very large projects now, and we only work for blue chip companies, so the quality of our receivable is top class. The quality is not at all an issue. However, since we increased our turnover by 30% last year. So if that reflects in our operating cash flows, that is only understandable. We also have new plants, and each plant has to have, a certain inventory level, because you can't be shifting materials from one factory to the other. So that has also caused our inventories to go up a bit high, because we are now opening new locations. But we don't see our operating cash flows as a big issue. We are, of course, working on increasing the throughput in terms of the cash conversion cycle, even in the large orders. But yes, when you do execute large orders and you have multiple plants, it can, in absolute terms, go up temporarily, but then it all comes back to normalcy. But I would request you to look at the number of days rather than the absolute increase in the operating cash.
Point taken, Manish. Thank you so much for joining us, giving us that perspective, and really appreciate you coming in and giving us those nuances around the business. Completely timed out, viewers, on this edition of All About Your Company. But if growth is anything to go by, you could well see 2,700 crore of top line versus the 1,900 crore FY26. In FY28, you could see that number. And if 10% margin on a conservative basis is pegged, you could well see profitability go from 135 to 200 crore. What you want to keep your eye out on is cash flow. And maybe it's a one-year thing. We'll try and see and maybe understand from management at the end of Q1 as well as to how some of those trends are shaping up with regard to FY27, which we are unable to ask management for now because we are in silent period. Thank you so much for joining us all the time we have on All About Your Company.